Hey everybody, welcome back for another Friday video update. Did you know that according to the Bank of Canada, over 60% of all Canadian mortgages are coming up for renewal in 2026? Translation: this is the biggest mortgage renewal wave in recent history. And if you own a home in Newfoundland, it's more likely than not that your mortgage is coming up for renewal in the next 12 months. Now, I know that many of you bought or last renewed in 2020, 2021 when rates were extremely low, like in the twos. And that means you're renewing into much higher payments this time around and much higher interest rates. And as we talk about on this channel, the last thing you need is a higher mortgage payment, on top of all the other expenses in your life that just seem to go up and up and up. But don't worry, I'm making this video today for you. We're going to break down the two biggest mistakes you need to avoid to get the most out of your mortgage renewal, potentially keep thousands of dollars within your household and out of the bank's pocket. And if you stick around till the very end, I'll be giving out one more bonus piece of advice about this upcoming renewal season that you definitely haven't heard about. So get ready and let's dive in. Hey everybody, I'm Mark Burry with East Coast Mortgage Brokers and the Leslie Penny team. Welcome to the channel where we stop treating your mortgage like a bill and start treating it like a tool to help you navigate the financial landscape right here in Newfoundland and Labrador. Now let's get right into it. The first mistake with renewals, and honestly the most common one I see, is waiting until the bank reaches out to you to start thinking about your renewal. They usually leave it until 30 to 60 days before your renewal date before they reach out. Listen, I'm dealing with a client in this exact situation right now, real life client. His bank emailed him a couple weeks back. They requested that he set up an appointment sometime between now and the renewal date. This was 60 days before his renewal. So he gave him a call, and the soonest appointment they could give him was 30 days before his renewal date. Now, with Christmas coming up, I don't know about you, but people on holidays and with things just moving generally slower in our industry that time of year, do you think 30 days gives him enough time to really assess all his options? Here's the rule you need to know. It's called the 120-day rule. You can secure a rate hold for 120 days. That's 4 full months before your mortgage renews. Think of it as like a free insurance policy. You've secured a rate. If rates go up in those 4 months, you're protected. You've secured that lower rate. And if rates go down, we just tear up the contract and you grab that new lower rate and you move on. It costs nothing to set it up, but it gives you 4 whole months peace of mind. So if your renewal is coming up in the next 4 to 6 months, don't wait for the bank to reach out to you. Reach out to me now. The second mistake is simply accepting the first offer that the bank puts in front of you. It's rarely their best rate, and we call this paying the lazy tax. Now, this isn't about being lazy. It's usually about being rushed. You pay a higher rate when you accept the bank's first offer just to get it done because you ran out of time to shop around. Let's go back to my real-life client. If he waits for that appointment, he'll walk into the bank with only a few weeks left before his renewal. They'll present him with a piece of paper with some terms and some rates, and he'll likely just sign whatever suits him at the time. Mostly because he feels cornered. But my point is that none of those rates on that piece of paper were the best rate that the bank could offer. And a broker can often do even better. Let's look at a real-life math example on this one. Say you have a $400,000 mortgage balance. Your bank offers you a renewal rate of 4.79%, but a broker could move you over to a monoline lender at 4.29%. That doesn't sound like a huge difference, right? Just a 0.5%. But let's look closer. That 0.5% difference adds about $115 a month to your payment. Over the course of a 5-year term, that adds up to roughly $7,000 in extra money leaving your household. So it took 30 seconds to accept that offer from the bank, put your signature on that page, and it cost you almost $7,000. I don't know about you boys, but My signature is definitely not worth that much. Now, I promised you a bonus tip at the end. And this one's for everybody who renovated their home during the pandemic. Think back to 2020, 2021. We were all locked down in our houses, staring at our own four walls. And what did a lot of people do? They actually took equity out of their home, they refinanced to remodel. Rates were super low, so people were taking this equity out, remodeling, building a deck, renovating the kitchen, putting in the man cave. But here's the catch. When you refinance to take out that equity, you technically broke your CMHC insurance. You voided it. So in the bank's eyes, you went from being an insured mortgage with a super low rate to an uninsured one. Now, rates were super low back then, so you probably didn't even notice it. But why does it matter now? Because you're heading into 2026. You're heading into a renewal in a much higher rate environment. And being uninsured is not what you want. So here's the broker advantage. If you switch to a broker, we have a third category called insurable. If you're one of those people who took out equity and refinanced in your last renewal, and you switch to a broker this time, as long as the purpose of the loan is not to take out more equity or refinance, we can likely switch you to a monoline lender who will treat you as insurable. Now, you gotta have at least 20% equity in your home and a standard amortization of 25 years or less. But if you meet those criteria, a broker can likely put you in the insurable bucket and get you a rate on your renewal that's a lot closer to a CMHC insured mortgage. And the best part is, this is actually done without paying the CMHC premium again. And that makes it a truly fantastic strategy for those of you who took out equity during your last renewal to do renos, consolidate debt, or whatever. Hope you find it helpful. So, whether you want to lock in that rate 120 days early, dodge the lazy tax, or just see if you qualify for that insurable loophole, I'm here to help. Send me a message, give me a call. And this renewal season, let's make sure your renewal puts money in your pocket. I'm Mark Burry, and we'll see you next Friday. Thanks so much, everybody.